Steph, I want to turn to you first.
Sure.
Do you think this is a week where we could see a lot of news that helps move the market higher, or is it still kind of bad news is good news is bad news, and no one knows what to make of all this?
I think good news is always good news. So that's just me as glass half full. But I think the most important number this week is going to be the CPI number, the inflation numbers, right? Because we know the economy has been resilient, led by the consumer focusing on and spending in services, which is 70% of consumption, right? Manufacturing, not great, but pockets are actually very good, like aviation, onshoring, anything tied to those two themes. That part of manufacturing is doing well. So that's led to above average growth in the economy, but above average growth in inflation. And so that's why I think the number is so important. Now, the headline, I think, is people are expecting that number to go up on a year-over-year basis from last month's number, 3.6 versus 3.3. And that's because of gasoline, basically up 31% since the lows. The core number, though, should be actually lower than expected. So I know the Fed thinks and focuses on the core over the headline, but I think the market might be spooked if we get a really hot headline number, and they kind of ignore the core for the time being. So I think you can see some volatility.
And of course, Joe, these are really important prints as we look ahead to what the Fed is going to do in September. How about retail sales and the state of the consumer on that side of the equation? How closely are you paying attention to that?
Well, I think that's critical, and I agree with what Stephanie is defining for the week. I think bad news is bad news for the market. To me, that seems to correlate not only with CPI, but for retail sales. That would be the biggest challenge that we have in the marketplace. If, in fact, retail sales exhibit that the consumer is beginning to decelerate in terms of its overall resiliency, we are at a moment that I believe is critical for the consumer. The moment in which the savings rate has eroded significantly, no longer can this consumer rely upon that.
The cumulative excess savings rate.
And then the fiscal support that the consumer has received over the last 24 months, again, that begins to fade somewhat. So now it's about a consumer that has to turn somewhere else if they're going to fund their spending desires. And where will they turn? They'll turn to regional banks and they'll turn to money center banks. And unfortunately, I think what they'll find in pivoting in that direction is far less receptiveness than they've been offered, certainly over the last 5 to 7 years. And that's a little bit of a challenge, I think, for consumer spending in the economy.
Yeah, well, lending standards certainly, Anastasia, have been tightened. And we've got this Barclays Financials conference this week where we should hear a lot. We've already started to hear a lot of commentary from some regional banks today. We'll hear from JP Morgan Chairman and CEO Jamie Dimon later in the hour to get his take. But so far, the lending environment certainly curtailed. Yeah. You've seen some job losses across Wall Street. I mean, how does all of this play into the narrative that we're seeing increasingly priced into stocks of, hey, I think we're going to reach the soft landing? Janet Yellen said it over the weekend, Treasury Secretary. How do you kind of pull all this together?
Yeah, well, we know that bank standards lending standards are certainly tightening. But at the same time, if I look for something else that might be good for the consumer, it's actually the fact that stocks are up and therefore the household net worth is also up. So, for example, the number that came out last week was $154 trillion in household net worth. And by the way, there's been a major pop in that change in that number in the second quarter, once again, because consumers are benefiting from this current stock environment. So I'm not necessarily very bearish on the consumer slowing down and therefore the bank sector, just not being able to support it. I will also say that last week, the narrative for the market was ISM services are stronger, oil is spiking, maybe therefore the Fed is going to have to do more. But if you look through those numbers, first of all, ISM services is not what the Fed is going to pay attention to, not that number standalone. They're going to pay attention to what Steph was mentioning, which is inflation, and the fact that this week we expect core CPI number to decelerate from 4.7% to 4.3%. That's a large sequential drop that I think will support kind of the Fed's desire to pause and will support the market. And then the other thing I would say, ISM services indicates the economy is strong. The number that I'm really encouraged by is the upwards earnings revisions relative to the downside. So if you look at the world number, for example, 3% is the revision for the world. But if you look at the U.S., plus 23% has been the net positive revision for U.S. stocks. So I'm encouraged by that. And so I think, if we have spikes in yields, I want to buy the dips in the market.
Actually, on earnings, we have had revisions higher, for the first time since the third quarter, right, of 2021.